So our final speaker of the session is Michael P. Wellman. Wellman is the Lynn A. Conway Collegiate Professor of Computer Science and Engineering at the University of Michigan. He received a PhD from MIT in 1988 for his work in qualitative probabilistic reasoning and decision theoretic planning. From 88 to 92, Wellman conducted research in these areas at the U.S. Air Force's Wright Laboratory. For more than 30 years, his research has focused on computational market mechanisms and game-theoretic reasoning methods with applications in e-commerce, finance, and cybersecurity. Michael's talk is titled Understanding the Implications of AI on Financial Markets.
Thanks. Yes, I will be talking about AI and financial markets. I'll also, toward the end, say something about methodology for more generally trying to understand the impact of advanced AI in multi-agent domains. But financial markets, I think, are pretty special, not just because I've been devoting a lot of time to studying them. Of course, the financial system is an incredibly important part of our economy. It is also something that we've learned and relearned, very fragile. And it happens to already be highly infiltrated by artificial intelligence. In fact, I would argue that algorithmic trading is really the first large-scale, impactful application of autonomous agents that we've seen. Autonomous in the sense that these are entities that are making decisions that are irrevocable and have consequences without any human in the loop to intervene. The reason that it may be actually surprising that in such a high stakes and risky domain this has happened, but well, why is it? Well, first, that's where the money is, and so there's a lot of motivation to try to get it to work there. And it turns out that computers have real advantages in terms of speed and precision and being able to process a lot of information from a lot of sources quickly compared to people. That combined with the simplicity of electronic interfaces to markets, pretty well-scoped domain, has made it possible to build agents that are successful there. So the question is, and it has been, does that matter that you have these algorithms in markets as opposed to people? Well, one reason it could matter is this very speed and precision. Because they're selected, because they can react much faster, what happens when you have entities that can react to information at millisecond or even microsecond timescales that people could not come close to? What happens when you have these autonomous systems with no humans in the loop that have to adapt and behave in situations that were not necessarily anticipated perfectly by their designers? What happens when you can deploy a new strategy and then scale it up to run not just in New York, but also in Paris, in London, in Tokyo, and not just in stocks, but in foreign exchange and in everything all at the same time? Well, we've been trying to understand that. The world has deployed this, and we're learning about it. Now, all of this I could have said, and I did say when we talked about this domain 10 years ago. Algorithmic trading has been around for longer than that. What I want to say a few words about what's new about the latest versions of AI and how that might affect financial markets. There's two aspects of that I'll categorize in this under new AI. One is deep reinforcement learning. What deep RL lets us do is automatically generate strategies. So not just that the strategies are implemented and operate autonomously, you can automate the process of coming up with the strategies in the first place based on machine learning. That's a pretty big deal. And the second, of course, is large language models or foundation models, generative AI. What does that do? Well, it does many things, but in particular, it opens up the language channel. Now, I mentioned earlier that actually one reason is that algorithmic trading was relatively easy to do is because it had a very well-defined, well-scoped interface. Didn't have to worry about arbitrary language interactions. Well, now that we can do that, we can go more places. You don't have to have a well-defined preset interface. You could probably adapt to newer interfaces very, very quickly with LLMs. You could also use the language channel to try to influence things as well. So I'll say a few words that address those. Both of these, though, separately and together, have the effect of potentially and likely dramatically expanding the scope of action and autonomy of AI in financial markets. We've been studying algorithmic trading in my research group for quite a while. The goal is not to say algorithmic trading is good or bad. That's really an irrelevant question. The questions are which kinds of strategies and tactics are helpful or harmful in what context? How do we design markets and design regulatory systems in order to make the world safe and effective for a world with algorithmic trading and AI? The methodological approach that we take is something that we call empirical game theoretic analysis, EGTA. It's a combination of agent-based modeling and game theory. So we have simulation models of financial market configurations and scenarios. You really need agent-based modeling. It's the only approach that lets you capture the complexity of these kinds of multi-agent systems that are dynamic and have just a lot of structure to them. But what distinguishes this from other approaches to agent-based modeling is that agent-based modeling has been criticized because it's too unconstrained. There's too many degrees of freedom. You can get anything to happen if you configure agents the right way. So we use game theory to try to select the rational configurations of agents, or the approximately rational ones, as arguing that those are going to be the relevant ones. We studied a lot of different scenarios in financial markets and in the financial system. I'm going to talk about one thread of that today, market manipulation. So a few years back, a finance colleague, Uday Rajan, and I wrote a paper that tried to categorize different levels of agent behavior in trading. We had a framework we called the arbitrage bot. At base, most trading strategies can be viewed as a kind of arbitrage finding. Algorithms are really good at scouring all the markets and finding mispricings, whether it be deterministic arbitrage or statistical arbitrage. And arguably, that kind of activity is usually benign or beneficial. But here's the rub. Once you're really good at finding arbitrage opportunities and exploiting them, you have an incentive, one could say a perverse incentive, for trying to change things so that they happen more often. That is, if you're really good at benefiting from mispricing, you want mispricings to happen, and you can maybe do things that would do that. And level 2 attempts to amplify these opportunities through purposeful instigation of market movements like spoofing. That's in the realm of market manipulation. And of course, there's other levels that I won't get into today. A couple of definitions from the U.S. regulatory system. The Securities and Exchange Commission defines market manipulation as intentional conduct designed to deceive investors by controlling or artificially affecting the market for a security. Notice this part about deceiving investors. It's really a kind of misinformation. Okay, so, and it has all the patterns of misinformation that we're studying in AI, just now applying it to information about a market. A particular brand of manipulation, spoofing, is further defined in U.S. law as bidding or offering with the intent to cancel the bid or offer. Okay, you're putting in an offer, it's a spoof. You didn't really mean that. You don't have no intent for it to execute, but it's going to manipulate. It's going to mislead others. I'm also going to say a few words about benchmark manipulation. I'm sure many of you know about the LIBOR scandal some years ago. That was an example of manipulating a benchmark. The other thing I want to point out, though, is that these legal definitions were written with the idea that you're concerned about people doing these things, and it focuses on the intent. And as you all, I'm sure, appreciate, understanding the intent of people might be different than agents, and that may have some consequences. Regulators, manipulation is happening all the time, and regulators want to prevent it. You could imagine we would like to use AI to help us do that. We could build a classifier using machine learning. It's a little bit tricky because there's not a whole lot of labeled data that's reliable that has a lot of instances of this manipulation. But they have ways to do it. I want to talk about a piece of work. Well, what it sets up is what we know of as an adversarial learning situation, just like these other misinformation kind of settings, where you build a detector that can classify behavior as manipulative or not, or benign. But then if you're the manipulator, you want to keep manipulating, but you want to evade the detector. And then that brings you in a kind of an arms race situation between manipulation and evasion, between detection and evasion, called adversarial learning. So I'll tell you about a piece of work that led by my student Xintong Wang, who's now on the faculty at Rutgers. We did a very simple kind of case study. We have a pattern of spoofing on the left, and just get an eyeball view. That's a particular pattern of things that was meant to goose the market. And that's a malign strategy. And a benign strategy on the right, market making. Very common thing, very reasonable. It also involves putting in orders and canceling them and putting in new orders. Market making is characterized by having a lot of buys and sells at different prices. And those are just patterns over time that we might observe. So we coded up a spoofer and a market maker, and then we did some learning to learn a detector that very well could tell the difference between those two kinds of time series. And then we said, let's do it. Let's simulate this cycle. So we have D0, which is the detector, the initial detector, and then we use adversarial learning techniques to generate a new order generator, which we'll call spoofer 1, which is trying to confuse the first detector 0, but still spoof. Okay, and then of course once we got a new detector D1 that could distinguish G1 from the manipulator, we would then do it again and go. As you can see on the bottom, this is how the spoofer evolves, and you can get the impression that it is basically obscuring its spoofing by putting in stuff that makes it look more like a market maker. And in this case, in doing so, it degraded its own manipulation effect, and so the detection was actually a good deterrent. But I would not count on that usually being the case, or always being the case. I think machine learning is a good, just like fermentation, it's a good thing to do. But what happens in the end of this arms race is really indeterminate, and I think will often be, not necessarily good. We've also shown, this is work led by my former student Megan Shearer, that you could learn to manipulate in the lab using reinforcement learning techniques. We set up a benchmark manipulation scenario. But we didn't tell it to manipulate, but we basically trained an agent to trade in this market with some outside interests in the benchmark. And sure enough, it learned to manipulate the benchmark. That is, it learned to lose money in the primary market in order to make money on the movement of the benchmark without us telling it to. And this is a way to maybe get around that those rules I told you about before that depend on intent. I can say, I just wrote an RL algorithm and told my bot to make some money. I had no idea it was going to manipulate anything. This is just an example of a kind of AI loophole that may exist in a lot of places when we're dealing with regulations and laws that are written under the assumption that humans are making the decisions. So what I've said about manipulation, we can capture it in an agent-based model. We get adversarial learning once we try to detect this kind of behavior. However, the results of those are indeterminate. We can automatically learn to manipulate. This might be an AI loophole. So on my list of concerns from AI and finance, the new AI and finance is are we going to see a new breed of super manipulators? Let me now change gears a little bit, and I'll have to go quickly through this. X equals finance is a really important case, but we also want to understand the implications of AI in multi-agent systems more broadly. And I'm concerned with interactive AI that's going to interact with other agents whose decisions, it's a strategic domain, they depend on the others. This is very complicated by a lot of uncertainty, but I want to focus on the strategic context issues. That is, the effectiveness of any particular strategy or agent behavior will depend on what the other agents are going to do. And you can't just take a worst case assumption because the worst case is just too pessimistic. You can get trivial conclusions. Presumably, systems that are trained to behave in multi-agent environments have to make some assumptions about what the other agents are going to do. What those assumptions are often opaque or maybe inconsistent, or even if they are consistent, they could turn out to be wrong. So we need to really understand, if we want to evaluate these agents, be able to understand them in the environments where the other possible agents could exist. We've done a study in a domain of sequential bargaining, have a set of items to trade it to divide up against a couple of individuals. They have different values for the different kinds of items. It proceeds over multiple rounds. It's a non-trivial game because it's non-zero sum, it's dynamic, there's private information. We defined a multi-agent training algorithm, or a MATA, as something that maps one of these multi-agent domains to a strategy, plus a random seed, to strategies for all the players. So this is, any multi-agent RL algorithm is a MATA, or any other kind of approach that does this. A MATA is a meta strategy because it's a strategy for coming up with strategies, right? Because you give it the domain, the game domain, as input, and it can generate, it learns to play that game well. So if we have meta strategies, we can create a meta game. So this is a game among MATAs. So these are now different AI algorithms for learning to play in multi-agent environments, can now play each other. We can define a game among those, and then come up with different measures about them. So to quantify uncertainty, we draw from all these MATAs are very sensitive to their randomness. So we resample from the random seeds to create different instances of the game, solve those, get some type of statistic out of that we're using to evaluate. Get a distribution over those. So I'm going to skip some. I'm going to take one measure. You don't have to be numbers. We can have a best response graph can be a measure. So rock, paper, scissors there's the best response graph for that. Rock beats scissors, paper beats rock, and so on. We did a study over this bargaining game. Tried a lot of state-of-the-art multi-agent reinforcement learning methods. I'm not going to talk about the performance chart, but looking at the results from the distribution over the best response graphs, what we see is that there's no dominant meta strategy. That would be a sink. Really, what is best depends on what else is there. And the other thing that we hadn't expected, but in retrospect makes a whole lot of sense, is that we found a general tendency for these MATAs to overfit to themselves. It makes sense. The designers of these learning algorithms, probably the thing they can account for best is something that behaves like themselves. They didn't know about the others. And that was quite interesting to us. We're exploring this with more games, and we're playing LLMs and negotiation games against each other. The public good games that Jingjing taught about would be, similarly interesting. So I'm out of time. So this evaluation framework gives us a general way to think through about how to evaluate advanced interactive AI in environments that may be different from what they were trained in. And we're also applying this to our work in financial markets. Thank you.
Thank you, Michael. So I'd like to take maybe 3 or 4 minutes for questions directed specifically at Michael, and then we'll open it up to questions to everyone. Yeah, sorry.
Firstly, Dr. Wellman, thank you for the talk. It's cool to see an industry-specific talk. So I am from the University of Waterloo, where a lot of my students are from our accounting and finance program. So now that these students, these wannabe bankers, wannabe traders, have to compete with AI systems that can, algorithmic trading has existed for a while, and so people have been leveraging this to execute the trades, but they would develop the strategy, right? That's where the people would kind of fit in. That's where my students would intend to go. Now that we have AI systems that are capable of generating strategy as well, what can I tell my students who kind of want to be involved in the financial system going forward? What does that world look like to them based on kind of what you've seen?
So first, it's kind of a losing game to say, like, what can you specialize in so you're not going to be taken over by AI? That's what we target. And these pictures of these traders in the pit, they're pretty much gone. People don't seem to be crying about that too much. They found other good things to do. I think in general the supervision is just moving to further, its arm's length, and it just gets further and further back. So there's still a lot of important things to do, but this automation expansion is certainly what we would expect.
Thanks for the talk. I've been following your work since 20 years, so very good. But now, because your experience in agents and building real agent systems, you may put a point of clarity on this new agentic hype, because I do believe that it's needed that the traditional researchers in the field that have been proving with real systems working try to calm down this hype, and also that's a proof that you can create systems that work in very regulated fields like financial markets. Maybe you can contribute with that, a reflection on that.
Okay, yeah, thanks. I think there's a communication problem. This term agent is very overloaded, and we are meaning either very different or slightly different things by sometimes, and so we just need to be clear in our own context that we're doing it. But that said, I think there's a lot of work that has been done in the AI, autonomous agent and multi-agent systems community that is quite, doesn't change just because the technology is an LLM versus something else. Some things really might change, and that's very interesting, right? And certainly, that community is also adopting these techniques. But by all means, we should be taking advantage of stuff we already know about agent systems.
Hello, my name is Syed, and this might be a very speculative question, but this is the right place to ask. Do you think it's possible that multi-agent systems, if different clusters of them can communicate with each other, in this context could lead to insider trading or type of insider trading?
So the issue of, well, first of all, let me say the communication usually brings up collusion, as first. So, and the interesting algorithmic issue is that these things can often learn to collude without communicating, right? And so without getting around other kinds of laws. So that issue is a really, I think, big one. I focus on market manipulation, but I could have picked any number of other ones. Insider trading is also a special issue. The thing I didn't mention in my last slide is really what I think is the version of that we should be concerned about. To the extent that whoever has the best information gets the best AI. The fact that there is a concentration of control over non-public information in certain companies opens up new opportunities for a kind of insider trading. So let's say a company collected information for from some other purpose. Could they use it to trade on? As far as I've been able to tell, it's in the United States would be legal to do that. Or could they sell it to hedge funds to trade on? The fact that the companies know that what we had for breakfast. That I think is we focus our concerns about our privacy on sort of individual individual violations, but in a way the collective value of this information is when it's concentrated, just poses a new kind of strategic question that probably should be addressed.
Hi, Mike. Great talk. A little bit of a left field question. So there's this issue that the law was not designed for AI, and ideally the solution to that would be very fast and adaptive legislation. That may not happen. I'm curious whether you think, is there any kind of like blanket guidance that one could give that would apply across existing law, where you would say something like, well, if the AI system behaves as if it has intent, then for the purpose of the law, we were going to treat it as intent. I'm curious as to your reaction to that. Is that a good idea, a bad idea?
Well, I think it's a good idea to try it, and I think it's a good idea to even be creative about thinking about intent in particular. For example, there are things you can do with AI to determine their intent. You can't do it, but you could ask the AI, the agent, counterfactual. Not only what bids did you put in, what would you have put in if the state were slightly different? And you could maybe even ultimately more reliably determine intent that way. But whether that would hold up in a legal dispute, I don't know. But I think that should be pursued to find the best way to apply the existing concepts to the AIs. But at the same time, I would love if regulators had a process of doing an inventory of all of their rules and regulations for AI loopholes. There is a pending bill in the United States Senate that tries to close a particular loophole that I mentioned, the Fair AI Act, something like that. I don't give it a whole lot of chance of becoming a law, but it would specifically say that if you build a learning system to trade, you're responsible for following the rules.
I'd like to also just open it up at this point for all speakers. He's been waiting for a while. Go ahead. No, sorry. No, you can.
Oh, sorry. Thanks. I had a question for Erica and Michael as well. With all we've been hearing about agents, in your case, the fragility of financial markets are really important. And just generally in terms of how humans react to situations like what happened with CrowdStrike. The utility of agents in those situations, the way I'm thinking about it, is really good until they're found out or until the system collapses, or in your case. Tell us a little bit about evasion and concealment. What are you seeing there's either where agents are developing it themselves. You said you didn't teach the agent to manipulate in your case, Michael, or in your case, Erica. To what extent is there anything we're learning about how agents can either collude or operate in a way that evades or conceals, cover their tracks, etc. If their conduct is like to lead to some event that might be like, catastrophic for humans or for damage fragile financial markets.
So I'm going to unhelpfully say that what I know about this is actually via the same public research that all of you know about it. So when it comes to things like, so just to be clear, like Meta does not have any agentic products right now. I mean, there's tool use, there's very simple tool use for like a web search. But so as of right now, everything I know would be the same as a lot of the discussions we've been having around evasion, deception, scheming throughout. From that perspective, I don't know that I have a ton to add to a lot of the perspectives that have already happened, but I'll let you say more.
I mean, certainly, a lot of malicious AI behavior is directed at individuals, scamming, there's a party. So, and of course, that's always really bad. But the things that are the higher level risks are the things that are systemic. Even things like manipulation are usually targeted at affecting particulars, and they have some other externalities. As far as we know, there's no one has. We're not aware of anyone who has plans to take down the financial system by trying to, exploit some vulnerabilities. That's partly because most actors, even nation states, have an interest in the world financial system not crashing. But that becomes a security issue. And I think we should always take the potential. We should understand how it could happen and treat it with urgency to try to prevent it.
I also, sorry, I did want to quickly add on to the question. One of the things I find interesting is not just the question of the agent's intent, but particularly when it comes to refusals or ways in which the agent might, in a multi-turn scenario with a person, understand that person's intent or not. And is an agent's understanding of a human's intent or the sort of person who's instructing it, that understanding of intent, how do we think about that is just as equally sort of a difficult concept to, relying on chain of thought and other ways to think about that, relying on the way an agent might talk about what it's planning to do, and then what it's thinking around the steps that it might take in the future. But I just wanted to add that I think a lot of folks are focused on the agent's intent, but there's also that question of how much it understands about others' intent when it comes to malicious actors.
It's maybe a dumb question, but if there's about I saw in The Economist this morning a report that the scamming now is about a 500 billion annual business, crime, organized crime. Crypto market is about 3 trillion anonymous owners. And open DeepSeek is out there, and Llama, and all this technology is now just everywhere. It's a question for each one of you. What are we going to do? Who do these agents report to? And it sounds like a recipe for chaos, frankly, with agents running around trading financially. Can they own crypto? Who do we know? What do we know there? What do we do about it? I'm curious. Thank you.
Right. So our way of protecting, the institutes that protect us are things like the banking system. So usually to get a bank account in regulated societies, you have to be a person with an identity, right, or a corporation. You have to, the banks have some responsibility for verifying these kinds of things. Depending on how crypto is regulated or not, I think that could be a place where that's going to enable a lot more nefarious behavior. I would, I think even totally separate from regulating the AI itself, if you harden the underlying financial system so that it is more difficult for parties to create fake identities and let programs control financial flows, we should do as much of that as we can ahead of time.
All right. Unfortunately, that's all the time we have for this exciting and terrifying topic. So let's give a round of applause for our speakers once more.